Is the housing market ever going to crash? It's one of the questions I get asked the most. It's one of the things I think about the most as well, because I want to take a look at the past to help understand the present, to help look towards the future as well. So what we're going to cover in this video, so you'll get my prediction by the very end for an actual target number and percentage by the end of 2030. If you take a look at just California for the median sale price, it's pretty normal from the 80s into the 90s into the early 2000s. As you see, recessions don't seem to bother the housing market in California. I just continue plugging along with slow, moderate appreciation or growth. And then in the mid 2000s, we had something called the housing crisis or the housing bubble, where all of a sudden you see a shoot up dramatically, peak, and then start to come down dramatically as well. This did coincide with the recession. The recession did not cause the housing crash. The housing crash helped contribute to the recession. So we bottomed out in the early 2010s, and then like a pretty fast pace of growth. It slowed a little bit since then, and here we are today. I want to take a look at this information to help make sense of it. Then also how understand basically what that shows us about our current situation and how to use that information to help predict the future. So let's take a look at California in the 1990s. So the first 5 to 6 years of that decade, you either had negative growth or no growth. And now how we finished the decade and finished the century and finished the millennium is on a heater. So the last 4 years made up for the first 5, 6 years of non or negative growth, to where you ended the decade up about 22% or about 2.2% per year. Not great growth, definitely below average appreciation for any type of market, but especially for California. But that is what California looked like in the 1990s. You go to the 2000s, you start to see some really interesting numbers. You probably remember the housing crash. I think everybody should remember the housing crash. So from 01 to 06, an incredible, insane amount of growth. So from 311,000 to more than doubling to 646,000 in 6 years, an insane level of growth. And then you have your housing crash. So the infamous housing crash, which took about 40% off the market. But if you look at the numbers overall for the decade, even with 4 years highly negative, you still averaged about 3.15% average growth, so 31% over the decade. Again, on the low end of what you'd expect for a typical market, it's still pretty healthy. Now let's go to the 2010s. Only 1 year negative back in 2011, every other year largely positive. So in this 10-year period, starting off with a negative year, California still appreciated 77%, so 7.7% average growth for the decade, which is way above normal. Normal's 3 to 5%, so 7.7% over a 10-year period is kind of insane. You fast forward to these past 5 years, and we're continuing on that trajectory. So it's not quite as hot. We're not at 7.7%, but we're at 5.5% average growth, 22% overall in the last 5 years. For the next 5 years, unknown. That's a lot of what we want to focus on. So this history kind of lets us know what's normal. I think generally most people understand that average appreciation for real estate markets can be about 3 to 5%. We'll show in the data that sometimes you're lower on the decade, sometimes you're higher on a decade, but it does tend to average out to around that 3 to 5% over time. We've been well above that for about 15 years now. So average housing appreciation, 3 to 5%. From 91 to 2010, the average appreciation was 4.04%. So in that, 20-year period, 4% average appreciation. Very normal. From 2011 to 2025, the average rate of appreciation has been 10%, which is incredibly high. So we went from being right smack dab in the middle of that 3 to 5% range to now we're way above it. We're off the charts with 10% correlating in this past year. So this kind of shows what that looks like on a graph. So that 20-year period, 4%. This one jumps quite a bit dramatically. So what history can teach us and how it helps us understand our now and our next is from 96 to 2006, California housing rose an astonishing 222%. The housing market then crashed 40% from 06 to 11, which is a giant amount, which a lot of people remember as being a devastating time period for us. But the result, if you look at it from 96 to 2011, the housing market appreciated 92.76%, or about 6% per year. So even after the housing crash, it was still an incredibly strong, healthy market. Pre and post crash, 6% average appreciation over a 15-year period is great. You'd love to see that if you are a California resident or if you're a housing professional in the area, 6% over 15 years. That's great. It's strong, it's healthy, it's looking good. Now, here's how we can use this information for now and for what's coming next. These are the assumptions that I want to make. So housing should continue to appreciate. That is true over time in every market, everywhere, with very few exceptions. So that is a general rule we want to apply. Second one is annual appreciation should normalize to around 3 to 5% for most markets over time. Always be outliers, largely with migration patterns affecting appreciation rates, but 3 to 5% for most markets over time is normal. Number 3 is where it gets interesting. If the housing markets gets too hot or too cold during one period, the following period should return the market to normal appreciation rates. This is where there's a lot of debate currently. We can use this information to establish price targets for 2030. So if you go back to our 2011 median sale price of $386,550 and you tack on a 3% averaged annualized appreciation, your 2030 median sale price should be around $618,000. If you do that same math using a 5% appreciation rate, you end up at $773,000. That would be a normal range if you had a 20-year period with 3 to 5% average annualized appreciation. We're currently in the 972 range, so we're off the charts high. What this would seem to suggest is that a downturn would return us back to normalized rates, which is one of those assumptions. So I wanted to look at this 2 different ways. So there is a bullish projection, which uses those 3 assumptions and only 2 are satisfied. So if you look at 2026 through 2030, and you say that, hey, housing should continue to go up, that's a rule. And then average appreciation should be 3 to 5%. So let's apply like a 3 to 5% appreciation over the next 5 years. It would establish a bullish price target of taking us from $970,000 to $1.2 million for the median sales price in California. That is a bullish projection. If you look at how that data works out, you have that 1.2 million price target for 2030, which would mean growth for basically these next 5 years of about 23.68% total. That would mean that growth for that 20-year period would be about 210%, and your annualized growth would be like 10.52% per year for 20 years. That number is gigantic. It's hard to do a 2-decade run with double-digit appreciation, but that is the bullish argument that that's where we are and that's where we should be. I'm going to look at a bearish argument instead. So for the market bears to make a bearish projection, they're going to say this first assumption won't apply for the next 5 years in order to make the other 2 assumptions work. So annual appreciation should normalize around 3 to 5% for most markets over time. And if the housing market has gotten too hot, it needs to cool down, which means that housing should not continue to appreciate for a short period of time. So what this could look like is if you look at that 2026 to 2030 projections or targets there, it's nearly a 30% drop from our current rates. And let's see what that would look like over a 20-year period. We'll be establishing a 2030 median price of $700,000. We're at $970 right now, so it's a pretty big drop. Growth would be minus 28%. The total growth, if you look at it from a 20-year period, would be at 81.09%. So for an average annualized growth or appreciation of 4%. So in order to make that 3 to 5% work over time, you need to have your 2030 median price end up in the mid 6s to like low to mid 7s. And again, we're pushing $1 million right now. So which one of these 2 projections makes more sense? Do you think California is so strong and thriving with a population boom and companies moving in and jobs moving in, and therefore we should have a 10.52% annualized return over a 20-year period? It doesn't seem to match what's actually happening in the state of California right now. I love the state. I'm born and raised here. I hope to die here as well. But I would be among the first to say that California is a wonderful place to be, and it's not currently in the healthiest condition. The alternative, where you're looking at, you know what, we probably do need some of the top taken off, and that would return us to a healthier market. because we have companies leaving, we have billionaires leaving, we have jobs leaving, we have net negative migration. It would make sense that housing would return to normal a little bit. And what normal would look like would be a price drop of around 30%. 31 of the 58 counties in California have decreased in value comparing December to December of the year prior. So over half the state is in decline currently if you look at it from a county by county level year over year. So my prediction, the California housing market will crash roughly 30% over the next 5 years, resulting in a median sale price of roughly $700,000 by 2030. You can't really call it a prediction if you don't put numbers behind it. And these numbers seem crazy, especially right now where things have just continued to go up and up and up for 15 years straight. But what I think the data would suggest, the state of our state would suggest, is that it's going to come down about 30% over the next 5 years. I was talking to some of the other dads of my daughter's softball team this past week as well. And they were asking the same question about like, hey, is this thing crashing? Are we coming down? And I let them know, like, well, typically in a crash, like it's maybe 5 to 6% a year, but over like 5 years. Like that's what happened in the last crash. Like it doesn't happen overnight like the stock market can. So in our next video, we're going to discuss what the federal or state governments can do to bring prices down slowly and to keep future bubbles from forming. Now, if this has been helpful, please stick around. So that video should be coming out about a week from today. If this is helpful at all, please subscribe. Please like. If you have questions or if you want to push back and say that I'm crazy, leave a comment. We read them all. We respond to them all. So I'd love to hear back from you. Thank you for watching. I'll see you guys in the next one. And hopefully I have some good news to share by the time 2030 rolls around. Thank you.